And again, our expectation is that this volume of transactions will slow, certainly during the first half of the year. There are fewer transactions in the pipeline at the moment, and potentially we could see some pickup towards the tail end of 2012, but probably a relatively quieter year from a transaction point of view. Where are we seeing the investment interest? Where do we like? Well, Australia is very much top of the agenda for many investors around the world, as I'm sure you're aware. There is product available. Whatever you think of yields here, certainly from an investor point of view, from a global perspective, yields here are relatively high. Good quality product, a nice liquid market. There's a lot of interest focused here in Australia if you can get your head around the strength of the Australian dollar. But as I said, it's an ugly contest. You don't have to be perfect to win in this environment. Japan, mainly Tokyo offices, is also attracting a lot of interest. Makes me slightly uncomfortable that a large part of that is not based on fundamental performance in the market. It's the liquidity of that market and the fact that debt is effectively free at the moment. So the spread between interest rates and yields is still very attractive, even though that market is expensive. And China, of course, very much on the agenda for many investors, still pretty much an opportunistic play. It's very difficult to buy core there. Retail, very much flavour of the month. If you can find a good shopping centre in China, then there are lots of active buyers. Generally, as I say, we expect volumes to moderate. Core does look expensive, but so long as that investment sentiment remains risk-off or close to it, we're still going to see demand. So, in conclusion, I mean, there are so many ifs out there at the moment. If the Eurozone stays intact, which I think it probably will, if the US continues to show the signs of improvement that it has, if there's one number to watch, it's the payroll numbers, it's the employment level in the US, that's key. If China does manage to achieve a managed slowdown, if we don't have another war in the Middle East, which is starting to look worryingly possible, and I have to say, if elections don't derail any of the political activities that are underway to try and prop up the economy, aside from that domestic that you've got going on here at the moment, there are major elections around the world, including 4 of the 5 members of the Security Council, so there's going to be a big year of political change. There's a lot of ifs and buts out there. And even though our central expectation is that all of these will come out relatively benign, it's a bit like betting on an accumulator race or accumulator at the races. Even if you bet on the favourite in every race, you still recognise that you're quite lucky if they all come in. And that's the uncertainty that's out there that's still affecting investors. I have to say, I don't think it's overly optimistic, however, to point out that investor sentiment, or sentiment generally, has to varying degrees been extremely negative around the world over much of the last 3 or 4 years. And as and when we do start to get all of these things lined up, and we do start seeing some signs that the recovery may truly be underway, I think that there is a possibility that the lifting of the weight, the sun coming out, at least in parts of the world, will actually cause quite a marked shift in sentiment, and from an economic activity point of view and a property point of view, we could see a bit of a bounce as we come through possibly the tail end of this year or into next year. So I hope that very quickly gives you a sort of helicopter view of how we see the world and how we see the major issues. I think that you'll see some echoes of all of this coming through as we move on to talk about the market here. But with that, please join me to take us through the outlook for Melbourne. Join me in welcoming to the stage Kevin Stanley.
Okay, well, good morning. Good morning, everyone, and thank you, Nick, for providing a really appropriate setting for us to talk about the outlook here in Australia and indeed Victoria, and of course more particularly in Melbourne. I think lots of ifs and buts is the kind of theme that I take away from what Nick had to say, and I think it's true too for Victoria, especially at this point in time. The headwinds, we think, are growing stronger against Victoria for 2012 at a time when the economic cycle is forecast to hit a low point before picking up again in 2013. Both the economic numbers and the property driver numbers seem to be pointing at a low point in 2012. The headwinds, of course, the European financial crisis is probably one of the biggest ones still that Victoria is exposed to. Unfortunately, it looks as though there's no quick fix, there's no easy answer to the European financial crisis. And so just as though there's no quick fix in that, business confidence will also, we assume, come back only very gradually. The other point about Europe, of course, is that the cost of capital is very much linked to the wholesale markets in Europe. And I think this really sets the scene for the outlook in Australia. That if the cost of debt stays high, then one of our key assumptions is that cap rates really can't compress much in the short term, which means the outlook is very much hinged still on what you do on the income side of commercial real estate. That's really how you'll add the value. And the slides, which I hope we'll show this morning, should show us that, should point to that income side and look at the issues around that and look at how we will actually grow the income side. So let me just refer to my notes for a moment while we get the AV up and running again. So I think the other key issues around Victoria is manufacturing. Of course, Melbourne is still very much the manufacturing heartland of Australia. We tend to take it for granted, but at a time when unemployment is starting to rise out of the manufacturing sector, we think that will give Victorians a negative sentiment. When you're opening the newspaper every week and you're seeing more job losses, not only does it directly lead to higher unemployment, but it also means that sentiment will come off the edge somewhat as a result of that. Further exacerbating that situation this year, of course, is the introduction of the carbon tax on the 1st of July, aimed very much at manufacturers to clean up their operations, and that might be a nice goal to have, but the timing of the introduction is certainly going to put a lot of added pressure back on the manufacturers in 2012. I think the one thing that Melbourne has always been so good at is transport infrastructure, and there's a lot of good projects which are in the pipeline for Melbourne and Victoria. We've seen over the last 10 years the introduction of these projects inevitably leads to more growth. It leads to opening up of land for urban development. It's allowed house and land packages to stay relatively low price by national standards, and that in turn has led to more migration coming into Victoria than we've seen to other parts of Australia. That's actually been one of the great formulas of the success of Victoria over the last 10 years. And as transport infrastructure investment starts to slow down, we think that the advantage of Victoria will also start to slow down relative to other parts of Australia. It's interesting, New South Wales is actually starting to get its act together in this area at the moment. But don't laugh, it's true. There's a new body being set up in New South Wales that's specifically aimed to really drive the transport infrastructure investment there and perhaps take some of this advantage of Victoria. I think one of the other key headwinds for Victoria in the year ahead is the wealth effect that comes from house prices. And we've seen back in that great phase of about 2006 through to about 2008 that rising house prices really gave the wealth effect a big boost in Victoria, and that a lot of things followed from that. And so as soon as house price growth starts to falter, which it has, confidence also slows down. And we think this will be an important area, particularly around retail, for the year ahead. So it's not often that we have a growth ranking, which I could show you if the charts was working, but I'm sure the guys are working full-time out the back there to get the slides up and running. But it's not. It's been over 10 years now that New South Wales growth has been above Victoria's. If we rank the growth for the year ahead across Australia, across the various states, Victoria for 2012 is actually at the bottom of the growth rankings. And New South Wales is above Victoria for the first time in 10 years. But really the key feature of 2012 is this significant variation in growth between the resources states and the non-resources states. And of course Victoria is a non-resource state